Are you investing with your goals in mind? As wealth advisors at Capita Financial Network, this is something that we ask our clients all the time because we want to make sure that your financial plan and your investment strategy align with your personal goals. So that's what we're going to be talking about today on Women in Wealth.
Welcome back to Women in Wealth. This is our YouTube channel that we've created to educate and to help people answer some questions that they might have about investing. And today we're going to be talking about just that. So how to make sure our goals and our strategy align with each other. I'm Katie Brinkerhoff. I'm a wealth advisor here at Capita Financial Network. I'm here with Alison Frasca. She's also a wealth advisor at Capita Financial. And we're going to dive right into how to align our goals and our strategy. If you have liked this is part of our investing season. If you've liked anything you've seen so far, or if you've found it to be helpful, then like and subscribe. We're happy that you're here. We're going to dive right in.
Okay, so today we're going to be jumping into 6 different investing rules of thumb. So we're going to talk about some different factors to consider when you're coming up with your investment strategy, or if you're working with a financial professional, some things to discuss with them as well. So the first one we're going to talk about is called time horizon. So this is really the lifespan or the time frame of your investment strategy. Oftentimes, this will be tied to your life expectancy. If it's for a specific goal, like buying a car or a home, then your time frame will be when you want to purchase those items. So it can really be dependent on whenever that money is going to be utilized. Some misconception that's in this area, oftentimes people think that their time horizon ends at their retirement, when realistically, we want to make sure that we're planning for the remainder of your life, even throughout your retirement, rather than just investing for your retirement day. So a general rule of thumb in the world of investing to think about is if you have a longer time horizon, so let's say it's a retirement account, maybe it's 10, 15, 20 plus years, then oftentimes you have room to be a little bit more aggressive with those investments, the longer time frame that you have. On the flip side, if you have a shorter time horizon, so let's say you want to buy a home in the next 3 to 5 years, then you might want to be a little bit more conservative with your investments on that front, because you have less time to recover from a bear market or a market downturn in a shorter time frame. So that's a general rule of thumb when it comes to time horizons for investing.
Perfect. Great job. Yeah, that's exactly right. The next one that we're going to talk about is going to be diversification. And so there is two main ways to create diversification when you're planning for any sort of goals. One of those is diversification in terms of what you're purchasing, in terms of what investments you're using. And one of those is diversification in terms of how you're saving, what kind of accounts you're saving in. So you want to create diversification in both. Talking about the first one, the investments, that just means that you're buying investments that are suitable for what goals you have. And there is a spectrum of risk across investments, and diversifying means that you have some that are maybe higher risk, some that are lower risk, but diversifying that means that you don't have all of your eggs in one basket is the best way to explain that. And so what we do when we're planning for clients is we choose hundreds to thousands of different stocks or other sort of investments, which means that if, for example, you have Apple stock and Apple stock does poorly, you don't lose everything. So you're diversified. That means that some stocks will go up, some will go down. There's lots of ways to diversify, but essentially not having all your eggs in one basket. And then another way that you can diversify is by having different types of accounts you put your money in. Some accounts have rules in terms of when you can pull the funds out, what taxes you pay on them. And so if you have multiple goals like retirement, buying a house, buying a car, you'll want to have different accounts that you're saving in so that you can diversify how your money can come out and serve you the best.
Yeah. And there's lots of different ways to diversify in your investments too. So there, like you said, like it's by account type, it can be by the different kinds of investments, but even within that world, you can purchase in different countries. You can purchase different industries or sectors in the world of investing, or different sizes of companies, because in different market cycles, each of those are going to perform a little bit differently. So you kind of mitigate that risk of losing money in markets when you have it more spread out, essentially. Like you said, just not putting all your eggs in one basket can be really, really helpful. So yeah, that's a great point.
One other thing that I'll add, this is just a really common question we get, is that sometimes people think they have to diversify across financial advisors. This is just a funny thing that people think, well, then I'll split my assets in half and give one to this one advisor, one to another. And one con of that is that when you have one person looking at your whole picture, they can see everything and they're going to make that diversification appropriate across all of your accounts. If you have two advisors, then they're going to choose two totally different strategies. And so it doesn't always work. So just if you have, any sort of concerns about, okay, does that mean I have to choose multiple advisors to help? That's not what we're referring to.
Yeah, true. And I think also the misconception there is assuming that you're going to get more diversification of your investments by working with multiple different people, whereas in reality, most advisors have access to the entire world of investing, so they can diversify as much as needed within your accounts just individually. So
love it. Cool.
Okay, so the next factor we're going to talk about that impacts your investment strategy is risk capacity and risk tolerance. So they're both associated with risk, but they're very different things. So risk tolerance is going to be how you feel about markets. How well do you sleep at night if markets are going down? Do you feel like there's a risk that you might change the plan when markets go down, because that can negatively impact your long-term financial plan? So that's something that you need to take into consideration. Whereas risk capacity is how much financial ability do you have to take on risk? So to give you kind of an example, let's say there's someone that plans on using a majority of their assets that they have saved throughout their retirement years, then you obviously have to make sure that you're mitigating risk so that it continues to provide the income that you need. Whereas, let's say there's someone with millions of dollars, they may not even touch most of these assets throughout their retirement years. Then you have the ability to take on a little bit more risk because you're not as dependent on the assets for income. So it really depends on your individual situation. But both of those things are things to consider, both the psychological side of how you feel about investing, as well as, what does your plan allow for, or what can it account for? Now, one thing that I like to mention is there's two main risks, I would say, in the world of investing. There's obviously the risk of losing money in the markets, which I would say most people are familiar with, but there's also the risk of not keeping up with inflation. And so sometimes people assume, okay, risk of loss, I might as well just stay out of the markets completely. But then you kind of shoot yourself in the foot because inflation continues to run and then your purchasing power goes down as well. So that's something to keep in mind too, is risk tolerance doesn't mean markets make me nervous, I'm never going to invest. It means finding an appropriate amount of risk to take on that will help you achieve your goals without putting psychological strain. So
yeah, perfect. Yeah, that goes really well with number 4, what we want to talk about with income needs. And so this is mostly specifically for people that are retired and are drawing money from their portfolios that they've saved, 401ks or IRAs. And there are ways to mitigate risk while you're doing that. And like you mentioned, it kind of depends on how much money you need and how much risk you can take on. If you're using the whole portfolio, you would take different risk than if you don't use the whole portfolio. And so that's exactly what I was going to talk about, is that depending on how much income you need, depends on how much risk you can take on. And there's ways to also mitigate that. So one strategy that we use when we build client portfolios here at Capita is a strategy called the bucketing approach, where you can really bucket your income into 3 different categories. We keep some of your money in short-term assets that you use for immediate cash needs over the next couple of years. And then we have medium-term buckets where we keep the money that we'll need in 5 to 7 years. And then we have long-term buckets. And the investments are different in those 3 buckets, which helps provide your income in retirement. And depending on how much income, what percentage of income you'll need of your entire portfolio over the next 2 to 3 years depends on how much risk you can take on in the other parts of your buckets. And so it's very kind of niche, I guess, to explain that. There's a strategy that you can use, but in general, there's also rules of thumb of you can take about 4% of your portfolio balance each year in income in retirement. That's the general rule of thumb, and it goes up as you age. But there's strategies in place, And those are the kind of rules of thumb for how to know how much income you'll need in retirement.
Yeah. And that, like you said, that leads well into the next point, which is your goals, because I would say this is the overarching point is there are rules of thumb when it comes to investing. There's different ways that you can align it based on your risk tolerance and your time horizon and income needs, like we've already talked about. And all of those are really important. But I would say the overarching thing that we want to focus on is your goals. So is the purpose of this account to provide your retirement income? Are you focused on providing a large inheritance for your heirs? Is it tied to a large goal like purchasing a home or paying for your kids' education or whatever it is? So goals is often the first thing I end up talking to clients about to get a better idea of what are we actually investing for? Mm-hmm. And then that will filter down into what is the time horizon? What are the income needs from this money and all that kind of stuff? So goals sometimes is a good place to start. And then, like I said, that filters down through the other factors that we've talked about, which then determines your asset allocation.
Yes, exactly. Yep. And this is the last one. There's some rules of thumb regarding asset allocation, which if you're not familiar with what that means how much stocks do you have in your portfolio, what percentage versus the bonds you have. And so if you're in the phase of life where you're just accumulating and you're, I would say 10 plus years away from retirement, it makes a lot of sense to be in all or mostly stocks. So the asset allocation is going to be more aggressive than as you near retirement, we taper back that risk and you start to put more bonds in your portfolio because that reduces the volatility or the amount of ups and downs that you'll have overall. And so the biggest factors that will determine what your asset allocation will be like all the things that'll wrap up this whole thing. So what's your risk capacity? What's your risk tolerance? How old are you? What are your goals? What are we saving for? Is it retirement or is it a new car? Or is it a new home? And then there's some other things we put in there, but that's how you can decide if your goals and your strategy align, really.
Yeah. And when I think about asset allocation, I like to think of it as, okay, based on this goal, this life stage, how much income you need from it, then I would be comfortable with, let's say, hypothetical example, 50 to 70% stock, somewhere in that range. And then where we land on that spectrum has a lot to do with your risk tolerance. And so it's kind of helpful to think of the bandwidth of what makes sense based on those more concrete factors. And then we align that with your personal capacity, or not capacity, but your personal tolerance for market movement.
Totally.
So like we talked about, we highlighted time horizon, risk tolerance and capacity, diversification, income needs, goals. All of that factors down into your asset allocation. And then once you determine asset allocation, so let's say, for example, you did 70% stock, 30% bonds, then you determine how to diversify into different stocks and bonds within those percentages. So those are just some investing rules of thumb. Obviously, it's all purely educational. So none of this is meant to be advice. If you do have a specific question or a specific situation that you'd like to ask, feel free to reach out to us via our website. But otherwise, we're so happy to have you guys here. We love talking about this stuff. This has been the next part of our investing season. And if there's anything else that you guys want to hear about, then drop a comment at the bottom. Otherwise, please like and subscribe, and we'll see you next time.